Welcome to this video on why commercial property is an excellent choice for investors, especially under new rules. Today we will cover the basics, essential fundamentals, and review some practical case studies. Before we begin, please note this legal disclaimer. This content is for general information purposes only and does not constitute financial, legal, or investment advice. Always seek independent professional guidance tailored to your specific circumstances. At Numero Group, we bring the best under one roof for a seamless experience. You can reach out to our portfolio strategist Anubhav Agarwal for expert guidance on your commercial property journey. Commercial property comes in many forms, including retail spaces like shops and malls, office buildings, industrial warehouses, mixed-use developments, specialized properties like childcare centers, and vacant land. Choosing the right asset class depends on your goals and risk profile. Options range from office suites and retail shops to industrial warehouses, medical facilities, and commercial strata suites, each with unique yield and entry profiles. Recent budget changes have shifted market dynamics. Commercial property offers opportunities for investors looking to move away from residential assets to potentially secure better cash flow and navigate new lending environments, especially when borrowing is getting tight. Smart investors are seeing real shift in adding positive geared and passive income to their portfolio mix for a more sustainable portfolio whilst focused on growth. When comparing commercial and residential properties, key differences include how market value is calculated, the nature of the tenants, lease lengths, and the responsibility for outgoings. Understanding these parameters is vital for any investor. Commercial investment has its pros and cons. Benefits include potentially higher yields, longer lease terms, and tenants covering outgoings. Conversely, you must be prepared for higher entry costs, longer vacancy periods, and specific market risks. Sourcing commercial property involves utilizing professional platforms to identify potential assets. You'll need to review key documents like the information memorandum and carefully analyze financial data before arranging property inspections. Understanding fundamental metrics is key to valuing commercial property. Concepts like net income, outgoings, lease structures, and capitalization rates are essential tools to determine the value and risk of your potential investment. Increase rent value goes up, reduce risk value goes up. What are we looking for in a property? We aim for detailed due diligence, opportunities to increase rent, high-quality tenants, long-term leases, strong locations, manageable risks, and potential for improvements like renovations. Let's look at an example. By assessing a property's net income and applying appropriate cap rates, we can determine its market value. Remember, as risk decreases, value generally increases. Even a small increase in rent through CPI adjustments can significantly impact property value over time. Here, we see how a 3% annual increase contributes to a higher valuation after 12 months. A reduction in the capitalization rate, reflecting decreased perceived risk, can lead to substantial value uplift. In this example, the combination of rental growth and yield compression generated a 14% uplift in just 1 year. Finally, another strategy to increase value is through multi-tenancy. By splitting a space into smaller units, you can diversify your income stream and potentially increase the total return of the asset. This slide illustrates the power of multi-tenancy. By splitting a 100 square meter space into two 50 square meter tenancies, you can see a significant uplift in value, demonstrating how optimizing usage drives higher returns. You can further increase value by leveraging additional opportunities within the property. Here, adding advertising rights and an ATM transformed the property's potential, substantially increasing the net income and overall asset value. Let's examine a retail opportunity featuring a dual income stream from an Australia Post, a general store, and fuel sales. This example highlights the importance of analyzing net yield and cash flow projections for your investment. In this motel investment example, we see how highway frontage and a diverse tenant mix, including cabin and room rentals, contribute to a solid return on investment. Always perform your own due diligence on the figures. For mixed-use assets, like this medical and pharmacy facility, look for properties with established, reputable tenants. The combination of retail shops and specialized services offers a stable, long-term income profile. Here is another strong multi-tenant commercial asset. Note the focus on lease expiry dates and option periods, which provide security and predictability for your investment cash flow. This example highlights a, quote, Resimmercial investment, blending commercial and residential tenancies. Such properties can offer unique diversification benefits within a single site. Focusing on specialized facilities like this medical center shows how location, land size, and strong lease terms are critical factors for ensuring sustainable, long-term rental income. This restaurant and residential unit combination is another way to achieve a balanced multi-tenant asset. Always verify the status of outgoings and CPI adjustments in your lease agreements. A well-structured portfolio can span multiple property types, from commercial spaces to residential units. Here, we see a case study of 7 properties, showcasing equity growth and positive gearing. Ready to take the next steps? Begin by clarifying your borrowing capacity, defining your specific investment strategy, and speaking with professionals to guide you through your commercial property journey. Thank you for watching this video. If you have any questions or would like to discuss your investment goals further, please feel free to reach out to our team at the contact details provided on screen.